everyone. Today we wanted to look at some data that JP Morgan was able to put together regarding consumer sentiment and how company stock prices perform based off of that. So this data is from the University of Michigan, which has been polling consumers in the United States since the 1940s regarding their feelings on their personal finances, as well as the broader state of the economy. And on this next slide, Daniel's going to share the insights that JP Morgan was able to put together in a chart format.
Thanks, Jack. Yeah, this chart is an interesting chart that just looks at how the consumer is feeling and then what actually happens in both the economy and in markets. So if you look at the left side here, consumer confidence is measured from about 40 to 120. Whenever it gets to a peak, that usually is indicating that consumers are at their most confident in terms of their spending. So they feel really good with how much money is coming in each month. They know they're going to have a steady paycheck. They're more likely to go out to a restaurant, do a home improvement project, maybe even purchase a luxury good. When you see the chart get near its bottom, that indicates a trough where the consumer does not feel as confident. And that means most likely they're probably going to spend a lot less money. They're maybe not as confident that they're even going to have a paycheck coming in. What you can see is sometimes these troughs have actually coincided with a recession. So what we wanted to look at is then, based on this chart, how do companies or the stocks that we actually own in our portfolios participate or perform after one of these peaks or one of these troughs? So as you can see here, the average 12-month return after a sentiment peak, so when consumers are at their all-time highs, is only about 3.5% return, which is actually fairly low for a 12-month period for the S&P 500. After it troughs, or we get to a very bottom, the average return is about 24%, which is a really good 12-month return for the S&P 500. So what we find here is that consumer sentiment is actually a pretty poor indicator of where we're at in terms of how the stock market or the companies that we own in our portfolios are actually going to perform. So if you go back to the chart here, Jack, where we're at right now in October of 2024 is we're at a consumer sentiment level of about 68.9. So we're actually not at a peak and we're not at a trough right now. We're somewhere in the middle, a little bit below the average. So if you go forward one slide, Jack, we want to make sure that we don't use our subjective feelings as Americans or the subjective feelings of other Americans as an indicator of how stock prices actually will perform in the next 12 months. When things feel gloomy or negative, oftentimes stock performances can be very strong in the next 12 months. So when we're at a level place like we are right now, we don't want to make investment decisions based on this chart, but we also can't just trust our own feelings or the feelings of other Americans on the economy, because oftentimes what we found is the economy can be decoupled or dissociated from actual performances of the companies that we own in our portfolios. The other thing we want to make sure is that we're always having the financial plan informing our investment decisions and not trying to time the market.
Absolutely. Thanks, Daniel. And so just like what Daniel just said, instead of basing investment decisions around our emotions, we believe it instead should be based off of what amount of monthly or annual investing is required to meet your stated goals for you and your family. And then on top of that, are there any short-term goals or needs that require funding prior to setting money aside for long-term investing and long-term goals? So as always, if you have any questions on any of this content or anything else as it relates to your financial situation, we'd love to set up a call. Thanks.